Welcome to another insightful episode. Today, we are going to dive into a question that's at the heart of every investor's journey. How long does it take to double your money through investments? Whether you are a seasoned investor or just starting, understanding the power of compounding and the factors that influence your investment growth is crucial for your financial success. Join us as we demystify the rule of 72 that you've probably heard of and explore strategies to accelerate your doubling time. So buckle up and get ready to unravel the secrets of wealth building through intelligent investments. Let's dive right in.
Welcome to the Financial Mirror. Where future success is reflected in our knowledge of fixing the one thing we can control, ourselves.
Thanks for joining me today on The Financial Mirror as we continue to improve the one thing you can control, yourself. This is not all about spreadsheets and numbers. This is about educating you so that you can make better financial decisions in your personal life to reach your financial goals. If this is the first time you are joining in, don't forget to hit subscribe on YouTube to be notified of all the new episodes as they release. If you are listening to this on a podcast platform of your choice, go ahead and like and subscribe to the podcast on Apple and Spotify. 5-star reviews, written comments go a long ways in educating those around you just by you sharing and spreading the word to more and more listeners. Today is an awesome episode because we really get to dive into the strategies and rules around how you can reach your financial goals. Many people out there are wanting to invest, they're wanting to get their money in the markets, they're wanting to do all these things, but then they're asking themselves, how long is this going to take? I've had my money in the market for 3 days and I'm not a millionaire yet. Not everybody is making the perfect Bitcoin entry points. Not everybody's jumping on the GameStop and the Bed Bath & Beyond train. There's an actual process to this, and some people hit the market right. I'm not going to say get lucky because sometimes there is a little bit of nuance, strategy, I guess you could say, around some of those things. But for the most part, today we are going to talk about something that is tried and true, and that is long-term investing, right? And how long does it take through long-term investing to double your money? To let you know, first and foremost, many people don't invest because, let's be real, it's kind of hard to sit back and just watch your money just sit there. It's kind of boring, right? It's actually really boring. But investing should be boring. If you are trying to not be actively in tuned every single nuance of the market, if you're not actively trying to watch every single dollar in the market and keep up with your account and go and research stocks and all these things, there's a good chance that it's boring, right? But the thing is many people, it's not about that. It's more about they want a new gadget. They want that new phone. They want a new widget. They want a new clothing item. They want something. And then they look at that account and they're like, I've got $100 sitting in that investment stuck there, man. And I want to get it out, right? Like a lot of people do that. A lot of people, they want that money. They don't want to let it sit there. But the good news is I'm here to tell you it is worth the wait. And today I want to show you why, if you will just wait, you will be able to buy so much more than that little widget and gadget and clothing item. You'll be able to really and truly make a difference with your money just by staying there, being patient, and waiting for that market to return your money to you with so much more than you put in. We're going to cover various parts today of this topic, but when it's over, you will have the knowledge to understand the timeline that it takes for you to get a better understanding of just how long it takes to double your money. So we're going to start out with the power of compounding, right? The power of compounding. As you can see on this slide from Investopedia, the definition of compound interest is the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest from previous periods, okay? So all this pretty much means is your money is you're going to invest your money into this whatever, right? And then that money is going to earn interest. And then that is now earned money. And that earned money plus your original investment is going to both earn interest. That will also earn interest. That will also, you see how this compounds, right? But why is that significant? You hear people talk about it, but maybe you just don't understand why it's significant. Well, the thing about it is that there's a factor in there that is guaranteed, right? When we think compound interest, there's a factor in there that's guaranteed. The factors that are not guaranteed is your return and how much money you're going to have to put into the market. That could change, right? You could get a job and that could go up. You could lose a job and that could go down. The market could return 20%. The market could return negative 20%. But one thing that is consistent when it comes to compound interest is that time is a definitive number and it will continue. Like time will continue and you have time in that equation that one day is one day, 1 year is 1 year, and 1 decade is 1 decade, right? Like that's the one thing that's for sure. So the thing about understanding that is that time will continue even when your returns and your investment, how much you're investing changes. But that's okay because that's the point. That means over time, your money, your investment is not going to be linear. It's not going to be like today it's worth 100 and tomorrow it's worth 102 or 105 or 110. Today it could be worth 100, tomorrow it could be worth 90, and the next day it could be worth 200. And then it could drop back to 125 and then go to 175 and then drop all the way back to 90 and then go to 300. Like it varies. It's totally variable. The one consistency here is time. Okay. So I really quick wanted to run through an example just so you can see a real life example of what an 8% annual return looks like. Okay. This is over 10 years. And the one thing that I want you to keep in mind as we look at this is that the only amount of money invested here by you or by me or whoever you want to apply this real life example to is the initial investment. In this case, it's $10,000, right? So it's a $10,000 initial investment. And the idea behind this real life example is that this person that put in this initial investment does not invest another dollar for these 10 years. Doesn't invest a single penny for these 10 years. As you can see, that initial investment after year one with an 8% return is worth $10,800. Still haven't invested any more money than the $10,000. The next year is worth $11,664. I'm going to shorten the numbers just so you can see it makes that these numbers go up. But it pretty much at year 5, it's going up $1,000, just around $1,000 each year, right? Just about. Year 10, we go 5 more years. The end of this 10-year period, that $10,000 has doubled. It's actually worth $11,384 more than the initial investment. It comes out at a whopping $21,384. Now you can see the power of compound interest, right? Because at an 8% return that you invested $10,000 and didn't touch it for 10 years, you doubled your money. Same could be true if you had invested $100,000. Same could be true if you had invested $500,000. Same principle applies, right? So that initial investment is important, but time is the one component that will continue. So the benefits of this is that if you will utilize time on your side, you will end up with more money, right? So here's a couple. Let's say that it's 2 friends, right? Investor 1, investor 2. Investor 1 starts investing at age 25. Everyone's heard this, right? 25 and sets aside $5,000 per year for 10 years, right? $5,000 per year for 10 years. Second investor doesn't start till 35 and invests $5,000 for 30 years, right? So invested 20 more years of their lifetime. However, when you look at age 65, the one that only invested for $5,000 for 10 years is worth $787,000. That's all it took. That's all it took. That's an 8% return compounded annually. That's all it took. start early. If you haven't started yet and you're, 50 years old, start early. Start now. Don't wait. Don't wait till tomorrow. Don't wait till the next day. Start early. You can see time gives your investments a chance to rebound and recover, right? This is the number one biggest factor of how wealthy you will be with compounding is time, right? This isn't the only reason to get started early, though. There are years when the markets have a downturn. The past few years have shown that. But there's also time gives your investments a chance to recover. So the longer you have this investment, the more turbulence that this investment can go through. And you can, by knowing that, take advantage of riskier investments because you have time to recover, right? So if you start early, you have time to recover if for some reason your investment starts to go south for a few years and then it shoots back up, right? But that's kind of the power of that. So the one thing that many people have heard of is the rule of 72. And I kind of want to go through it because it's a great, straightforward, quick tool for you to estimate how long it's going to take for your money to double, right? Super simple, very widely used. But it definitely comes with some factors that are not included, right? And I'm going to explain that. So, how this works is you take 72 and you divide it by the rate of growth that you think you're going to have, right? So if you did 72 and you think you're going to get a 7% return, which is fairly conservative and can provide to be semi-accurate most of the time, 7%. If you did that, it would take you about 10.2 years for your money to double, okay? So we kind of saw that, right? We kind of saw that in that example where we had an 8% return and it took about 10 years and it had doubled. So we can see that. We can see that. Now, here's the issue. So but hold on, before I get to the issue, let me say this. The thing about it is this is a simple calculation. It takes at a moment in time, it tells you how long it's going to take your money to recover or to double. The thing about that is it's not very good because it doesn't take into account that this isn't like a one-time deal. Like you could use this to say at the end of this year, I'm going to have invested $10,000 and then I do a 7% return. I could say at the end of this year, that 10,000 will be 20,000. Make sense? So it's like a moment in time. Like that's it. Like just that moment. And then you like it doesn't take into account how all the money you're going to put in over those 10 years. Does that make sense? Hopefully that makes sense. That's a very big limitation. However, it's very good for quickly coming up with how long it's going to take, right? That's like the beauty of it. And the good part is that the word double means double. And let me tell you what I mean by that. It takes just as long for 10,000 to turn into 20,000 as it takes for 500,000 to turn into 1 million, as it takes for 5 million to turn into 10 million. You see the power of this thing? Double is double. Like just pick the number you want to double, and it takes 10 years to do it at that rate of return. And that's true. That's real life, right? Now, this simple formula is great for quick assessments. However, it does have some limitations. So it's perfect, it's not going to be perfectly accurate. Even this is not going to be perfectly accurate, but this is a better guide to use because this is not looking at a single investment at a single point in time, right? Because like I said, that would be assuming that you're going to make an investment and never invest another dollar, which is probably not the case. So how can we better determine the length of time to double your money? Well, this is what I wanted to introduce to you today. This is where we're going to discuss a wealth savings rate, right? We've talked about wealth before, right? This is assets minus liabilities. And what the wealth savings rate will do is take into account like how much, first off, it will look at how long it's going to take your wealth, your net worth to double. So if I want to, my investments is only a pinch of it. If I want to say I'm putting 2,000 in this account, 5,000 in this account, and 3,000 in this account, I'm saving $10,000 a year, let's say, right? And let's say that I make $100,000 a year, right? That this gives us some numbers to work with to look at what a wealth savings rate is. Okay. So let's say this. You need to determine how much you expect to save annually and use that in reference to your current amount of wealth accumulated, right? That's what's going to come up with your wealth savings rate. So if you currently have a net worth or you have $50,000 in wealth and you save $5,000 annually, this would give you a 10% wealth savings rate. You're saving $5,000 annually and you're currently worth $50,000. So you do 5 divided by 50 and that gives you a 10% wealth savings rate because you're saving 10% of what your overall wealth or overall net worth is. Now, let's assume a 7% return. That means that technically by doing this, $5,000 a year, your money will actually double in 5 years, right? Your actual net worth will be $100,000 in 5 years. That makes sense? You can use this chart to come up with your wealth savings rate, which is how much you're saving each year divided by your net worth and divided by your wealth. And that's how you're going to come up with, and then you need to pick a 5, 6, or 7% return. And then that'll give you how long it'll actually take your net worth to change. And this is helpful because you don't have to now look at a point in time, this like single point in time like snapshot of how long it's going to take this dollar to double, this $10,000 to double. It goes beyond that, right? So this is a much better, much more accurate way to track that. Now, will the rule of 72 get you there? Sure. It'll give you a great estimate. It'll put you in the ballpark. But if you really want to play ball and you really want to know what this is going to look like, this is where you do it. Wealth savings rate. Now, there are factors that influence how long it's going to take it to double, right? And we talked about a couple, but the first one that I wanted to discuss is the rate of return. Now, I kind of want to give you a range, but I will tell you this. The rate of return is going to base everything. It comes off of the market, but it is completely based off of the overall market and how it is doing. Okay, how it is doing. You need to determine what rate of return you want to go with and feel comfortable with. Here on this chart, you can see this is for the stock market for the S&P 500. You can see the kind of range of return is like 7 to 8%. It's kind of the average, right? Kind of the average, depending on which one you want to look at, kind of the average. So this will show you that a 7 to 10% return annually is solid, right? It's solid. So if you choose a 7%, pretty good accurate number for you to determine how long it's going to take your money to double. Great guide and calculation. Now, maybe you want to be, let's go back. Maybe you want to be at the 5 or 6% return. You're like, I want to be a little bit more conservative with it. I don't really want to, bump up next to that 7 and never get a 7. And now it takes my money, a little bit longer I want to be a little bit more conservative and it's faster. Cool. That's excellent. Excellent. Good part is you have choices. You have choices and you can pick that. Pick what rate of return you want to go with and then know that could vary, but overall you should be able to stick to what it is. As I said with the market, stocks hover between 7 and 10 annually, but choose 7. 7's a great number. It's very conservative, but it will help you in getting you a pretty semi-accurate timeline for how long it's going to take your money to double. Keep that in mind. Now, there are different asset classes that are out there. Like I said, stocks hover. So let's start with cash. Cash you're going to get in a savings account right now, a high yield. I pulled a report yesterday. Most of them are sitting between 4 and 4.5 right now. Savings accounts will generally sit up between around 2% for a high yield. Okay, 1.9, somewhere in there. Now, are there some that are less? Sure. Are there some that are more? Potentially. 1.9 is about average. Right now, we're at about a 4 or 4.5 for a savings account, which is awesome, right? That's awesome. Stocks average around 7 to 10%. Like I said, I'd go with 7 to be for sure. Bonds are less risky, but they're only going to give you around a 2 to 3% annual return. And then real estate, it kind of sits around 3 to 5% annually on equity increases, right? So I say all that to say, if you figured out where you're going to invest and use some of those ballpark estimates I just provided, you can kind of come up with, like, if most of your money is going to be in bonds and savings accounts and you're going to have very little in the stock market, maybe that 5% is more like what you're going to be earning annually as a rate of return, right? And that's okay. Just understand that it's going to take your money a little longer to double. Now, this is one thing. So we talked rate of return and we've talked different classes of money, but we all know that there are economic conditions and market fluctuations. Here's a chart of the S&P 500 over, pretty much the last 10 years. So from 2010 till 2020 with the COVID, you can see there's been 2, 4, 6, 8, 10 different events that have happened that have resulted in the market pulling back for whatever reason, right? There are obvious things like economic and political events are going to influence the market, and that's going to influence your rate of return. So keeping that in mind, that on average, though, the market still sits around 7%. Even with all these pullbacks, the market still sits around 7%. Keep that in mind, okay? COVID killed and rebuilt the markets. Elections kill and rebuild markets. Rate hikes affect markets. Everything affects markets, okay? So don't watch your account every day because everything affects markets. Now, last thing that does affect your rate of return is fees and expenses. Just know there's a huge delta in how much your money will be worth if you put money into investments with high fees. You can see this green line right here over a 20-year period. This is the difference in a 0.25 annual fee, 0.5 annual fee, and a 1% annual fee. And you can see a 1% annual fee will end you up about $30K less compared to the 0.25% annual fee. Annual fees will destroy accounts. So pick, I can't emphasize it enough. Pick funds that have low fees. They're out there. If you want to invest in Vanguard funds, get a Vanguard brokerage account. If you want to invest in Fidelity funds, get a Fidelity account. And I say that because they don't charge fees for their, or they have small fees. I won't say no fees. They have low fees for their funds. So do that. Best thing you can do, and everyone talks about diversification, but I gave you some different asset classes. Put your money across all of them, right? You don't, like, real estate might just be your primary residence, right? But that's still going to give you money, still going to increase your net worth. Put money across all of them. Put money in savings, put money in stocks, put money in bonds, right? Like, just move money across all of them. Don't just settle in one. Just not the best idea. Now, a couple of strategies you can use to accelerate your doubling time. Increase your contributions. Increase your contributions. You can see on this chart, you can be a millionaire at this age. Just a little chart. If you save $2,000 a year, and you start at 15, you would be a millionaire by 67. If you save $2,000 a year and you're 40, you're not going to hit millionaire status until 92. If you save $2,000 a year and you're 65, you better live that long life, because you're going to hit a millionaire status at 117 years old. Now, let's be real. You could save $10,000 a year. You could save $6,000, $8,000 a year. And if you did that, and I don't care if you're 35, I don't care if you're 40, let's do 40 and you save $8,000 a year, you would be a millionaire by 73. You save $8,000 a year and you're 45, you'll be a millionaire by 78, right? And you might not need $1 million. This is just an estimate. But you can see how if you can get up there to where you're saving, $18,000 a year and you're 40 years old, you're going to be a millionaire by 63 years old, right? It's pretty awesome. You're right at the entry of Social Security age and you're already a millionaire. Figure out how much you can save each year and attack it. Go after it. You can do it. But this is the best way to decrease the amount of time to double your money, is just increase your wealth savings rate. How much are you saving in comparison to your wealth, and watch your net worth double and double and double. The other thing you can do is you can utilize employer-sponsored retirement plans and the benefits that go with those. Here's one. This is just an example company, but 100% match on the first 3%, 50% match on 4 and 5%. So if you did a 5% contribution, you would contribute $96 and your employer would contribute $76 and you'd have $173. These percents and numbers are just arbitrarily provided. They're not like, you can take the percent and calculate it for yourself, but this is just an example. Like, you're putting in 96 and your employer's putting in 76. Like, that's free money to you. So if you want to double your money faster, get the free money your company's handing out to you, right? Take that and run with it. Get that into that account and let that start to compound. Big thing, big thing. This will mean you could possibly have a 10% savings rate, wealth savings rate, and then get some free money for matching your contributions and put that even higher, right? But here's the key. I'm going to wrap this up with this. The key contributing factor to how wealthy you will be is a little story, right? This is the key, is this little story about the net worth of Warren Buffett, right? Little story to wrap this up, and I just hope this hits home for you. I hope this is the home run that just knocks this out of the park and puts a bow on why you should start yesterday, right? Warren Buffett started very early in life investing, right? Very early in life. Started investing at 14 years old, right? Now, let's say this. At 14 years old, Warren Buffett had accumulated $5,000 in wealth. At 15, he had accumulated $6,000. At 19, he had accumulated to $10,000, and at 21, he was worth $20,000. Many of us can relate. Let's just say that at age 30, Warren Buffett was worth $24,000 instead of the $1 million he was actually worth. So at age 30, Warren Buffett was worth $1 million, real life. But let's compare it to you and I and say we're only worth $24,000 instead at age 30. If he would have went on to make the same returns for the rest of his life, right? And he's still alive as of this recording. He's still alive. He would have been worth $1 million. Or excuse me, he would have been worth $1.9 billion. I read my notes wrong. He would have been worth $1.9 billion today. And you're probably like, holy cow, that's a lot of money. $1.9 billion is a lot of money. However, the end of the story is this. Today, Warren Buffett is worth $81 billion. $81 billion. If he had started investing at age 30 and had a net worth of $24,000 at age 30, instead of 1 million, he would have been worth 1.9 billion instead of 81 billion. So you're talking he's worth 80 billion more dollars because he started at age 14. Isn't that nuts? That is totally nuts. Therefore, we can account, based off of this story, 97% of Warren Buffett's net worth was built in his teens and 20s. 97%. And many of us didn't get started at 14 like Warren Buffett did, and that's okay. Because think about it. Even if you ended up with that 1.9 billion because you're 30 and you have a net worth of 24,000, if you could end up with 1 billion because you started at 30, wouldn't that be awesome? Now, we may not ever be worth $1 billion, but if you will listen to the Financial Mirror and take the actionable steps that we go over, you can use this episode's information and all future and previous episodes' information to easily become a millionaire in your lifetime, multi-millionaire in your lifetime. Start today, and I guarantee it that is in your future, right? And if things go and you hit one of those GameStop, Bed Bath & Beyond, Bitcoin type of investments, then maybe that 81 billion will be a lot more reasonable for you. But all in all, just know you will be a millionaire if you'll start today. Now, if you are ready to take control of your finances, and this absolutely just hit the spot on what you need to do you have an idea of what you need to do, but you just need to critique it just a little bit more, head over to thefinancialmirror.org and hit book now in the middle of the screen and schedule your free consultation today. This will give you an opportunity to get, like I said, about 15 minutes of time with me. We'll sit down and see what's the right plan for you, and then we'll go from there. If it's not, my services are not the right fit for you, and we determine that, I will wish you the best and no hard feelings, and we will move on, and you'll go out and still be successful. But if there's something I can do to help, I want to identify that, and I want to help you get to where you want to be. If you do want to give an extra dose of support to the stream, head over to thefinancialmirror.org/shop and pick you up some awesome Financial Mirror gear. All of it goes back to the stream and helps continue to grow the stream and put more content out for more and more listeners. I truly appreciate everyone tuning in today. If you enjoyed the episode, if you got something out of this, if you're ready to build that net worth and you know other people around you are too, head over to that share button, that like button, that comment button, that subscribe button, all those buttons across all the different platforms, the YouTubes, the Facebooks, the podcasts, and share this out. Like it, comment it, get it out to more and more people so that we can all be successful with our finances together. Hope you got something out of this. Hopefully you'll take some away, go figure out what that wealth savings rate is for you, and figure out how long it's going to take you to double your net worth today. Till next week, continue improving the one thing you can control, yourself. Peace.
Well, that wraps up today's Financial Mirror. Join us next week as we continue to work on ourselves, change our mentality, and to commit to achieving the success we always envisioned. Regardless of your platform, help us grow as a community. Please like, subscribe, and share with the people in your lives.